Your bank balance, daily purchases, and long-term investments are no longer just personal decisions. They're all about to come under the spotlight. The UK is rolling out a new arsenal of financial laws, poised to change not only how you interact with your money, but also how you plan for your family's security and your own future ambitions. These changes aren't just policy tweaks, they're signals of a brand new era, where adapting quickly might be the only way to stay ahead. Dive in now to see which laws could reshape your life, and what you can start doing today to protect your financial edge. Number 10. Pension Reform Act 2025. The Pension Reform Act 2025 ushers in comprehensive adjustments to the UK's retirement savings landscape. One of the central changes is the revision of age thresholds and withdrawal rules for private and workplace pensions, affecting when and how citizens access retirement funds. The law raises the minimum age for tax-free lump sum withdrawals and introduces new limits on annual withdrawal amounts, reflecting an effort to extend retirement security and discourage premature depletion of savings. These measures primarily target longevity risk, recognizing increased life expectancy and the need for sustained income throughout retirement years. Individuals must now plan for longer periods with staggered pension access, which could require increased contributions during working years. Enhanced tax bans on withdrawals also mean that larger pension payments are subject to more significant deductions, compelling retirees to optimize their finances carefully and evaluate the best timing for accessing benefits. Financial planners highlight that the Act brings greater clarity and predictability to retirement strategies, but raises the stakes for those approaching pension age. The legislation sets more defined rules for employer-sponsored schemes, making it mandatory for companies to regularly update their pension offerings and ensure members are adequately informed. Automatic enrolment contributions have been marginally increased, supporting a gradual transition toward more robust retirement funds for future generations. Adjustments to the approval process for early withdrawals mean appraisals will consider financial necessity, health status, and dependence, establishing stricter but safer standards for exceptional circumstances. Pension providers must now deliver annual transparency reports, summarising the projected growth and state of each member's savings pot, making personal financial planning more straightforward. For those at risk of falling below the minimum retirement income, state support programs have been expanded, while tax incentives encourage additional voluntary saving for those who wish to supplement their pensions. For the average UK worker, these changes represent a pivotal recalibration in how retirement is approached, managed, and sustained. Citizens will need to prioritise early contribution, understand new tax liabilities, and adjust budgets to ensure long-term welfare. Reviewing pension arrangements before retirement is now more important, with advisors suggesting regular assessments to align contribution rates with updated government guidelines. The Pension Reform Act 2025 underlines the government's commitment to future-proofing retirement systems against demographic and economic shifts, reinforcing the role of financial literacy and proactive planning as keys to a secure and comfortable post-employment life. Number 9. Cash Usage Limitation Directive. The Cash Usage Limitation Directive represents one of the UK's boldest steps toward a near-cashless economy. Under this law, cash transactions exceeding $3,000 between individuals or businesses must now be formally declared through registered payment systems. The aim is to minimise tax evasion, curb untraceable trade, and align domestic finance with anti-money laundering frameworks already in use across the European Union. Everyday citizens can still use cash for small-scale purchases, but large payments, such as car sales, rent advances, or contractor fees, must go through traceable digital channels. Banks are required to flag repeated deposits of large sums, while businesses accepting above-limit cash payments face steep penalties for non-compliance. For small merchants and freelancers, this rule introduces both convenience and caution. Digital invoicing and mobile transfers make accounting easier, yet they also place every transaction under regulatory scrutiny. Some privacy advocates argue that the directive undermines personal freedom by restricting how citizens use legally earned money. However, supporters claim it strengthens consumer protection and economic transparency, eliminating the underground cash economy that often fuels unrecorded trade. With better transaction data, policymakers can more accurately assess economic health and respond to financial instability with precision. Over time, the Cash Usage Limitation Directive is expected to change spending culture across the UK. Citizens will increasingly depend on digital payments, accelerating the adoption of fintech apps and official e-wallets. Traditional cash handling industries, such as independent retail and informal labour markets, may face short-term adaptation challenges but long-term benefits through safety, automation, and traceability. The law ultimately positions the UK closer to a digitally integrated economic model, where every pound spent contributes to measurable growth, accountability, and modernisation of national finance. Number 8. Universal Transaction Record System. The Universal Transaction Record System introduces one of the most sweeping transformations in financial oversight across the United Kingdom. This law mandates that all banks, credit unions, and fintech companies maintain a centralised ledger accessible to authorised government agencies. Its core function is to ensure every significant transaction, whether domestic or international, leaves a traceable digital footprint. This shift aims to enhance transparency, reduce financial fraud, and uncover hidden flows of money linked to criminal operations or tax evasion. Transactions above the defined threshold are automatically flagged for review, eliminating manual reporting loopholes. The system consolidates data that was once fragmented across various platforms, giving regulators a unified view of financial activity. Although this measure improves security and policy planning, privacy advocates highlight potential risks surrounding data confidentiality and misuse. Citizens' financial behaviours could now be monitored more closely, making personal finance management both more accountable and more exposed to institutional observation. Supporters argue that the Universal Transaction Record System establishes greater trust in digital finance, especially in an era marked by rising online transactions. With all major institutions interconnected under a government-approved framework, the likelihood of identity theft, tax evasion, or untraceable remittances drops sharply. This also enables faster financial crime investigations, helping protect consumers and stabilise the monetary system. Banks must now upgrade their internal software to ensure real-time synchronisation with the National Transaction Grid, which allows regulators to detect suspicious patterns instantly. For the average individual, these updates may appear invisible, but the system fundamentally changes how financial institutions handle customer information. While security protocols have been strengthened using encryption and AI-driven supervision tools, the data's centralisation demands accountability and ethical data stewardship from both private banks and public agencies managing access rights. For everyday users, this law underscores the importance of transparency and accurate record keeping. Any attempt to conceal income or misreport financial activities could now trigger automated alerts. Citizens are encouraged to regularly monitor online statements to identify inconsistencies that might mistakenly raise red flags. For businesses, maintaining precise transaction logs and ensuring tax compliance becomes vital under this structure, while the Universal Transaction Record System grants the state unprecedented insight into national cash flows. It equally represents a step toward modernising the economy, where responsibility and innovation coexist to create a more transparent and fraud-resistant financial environment. Number 7. Savings and Interest Adjustment Rule. The Savings and Interest Adjustment Rule has reshaped how British citizens manage and grow their personal savings. This law redefines the limits on tax-free savings accounts, ISAs, and modifies the way interest earnings are calculated and reported. The annual ISA allowance has been reduced to encourage a broader distribution of wealth, while new rules restrict citizens from holding excessive balances in low-interest accounts without taxation. Any interest earned beyond the set threshold now becomes subject to incremental tax bans. The government's reasoning behind the adjustment is to stimulate active investment and discourage passive hoarding of capital. Banks are also required to provide transparent disclosure statements, highlighting net interest after taxation to ensure clarity for account holders. For savers accustomed to traditional long-term deposits, these reforms demand a more strategic approach to wealth planning and diversification. The law essentially encourages citizens to move from conventional savings accounts toward instruments that contribute more effectively to the real economy. Financial strategists argue that while this rule reduces certain benefits once enjoyed by high savers, it also motivates smarter portfolio management. By linking returns to inflation-adjusted rates, the new framework aims to protect savings value in volatile economic conditions. It also introduces caps on the total amount eligible for preferential interest rates, limiting high-income individuals from monopolizing tax-free yields. For young professionals or middle-income earners, the change may initially seem minor, yet it gradually shapes more dynamic financial behavior. Many experts recommend leveraging national bonds, mutual funds, or diversified equities to balance risk and maximize post-tax returns. The rule structure pushes financial institutions to compete through innovative savings schemes that promote economic circulation rather than idle deposits. As a result, more competitive products and digital investment platforms are expected to emerge, giving savers modern tools to optimize their finances under the new regulations. For ordinary households, this change acts as a call to re-evaluate saving habits. Simply storing money without strategic planning may now yield diminished benefits, prompting greater awareness about finance and taxation. Financial advisors play a stronger role in helping citizens align savings goals with legislative requirements. The adjustment fosters a savings culture centered around planning, growth, and flexibility rather than passive accumulation. Although the savings landscape becomes more intricate under this law, it ultimately aims to develop an informed society capable of building wealth sustainably while supporting broader national financial stability. Number 6. Crypto Asset Regulation and Licensing Act. The Crypto Asset Regulation and Licensing Act marks a decisive moment for the digital financial ecosystem in the United Kingdom. Under this law, every cryptocurrency exchange and digital asset platform operating within the country must obtain an official license from the Financial Conduct Authority before offering services to residents. The government introduced this measure to combat money laundering, tax evasion, and unregulated crypto speculation that had surged in recent years. The Act sets strict requirements for reporting, user verification, and the segregation of client funds. Any unregistered or non-compliant exchange faces immediate prohibition and significant fines. These changes aim to establish the UK as a safe and credible hub for digital currency trading while ensuring consumer protection in an increasingly volatile market. To operate legally, businesses must provide full transparency about their security protocols and maintain accessible audit trails. This framework is designed to minimize risks for investors and stabilize the overall crypto market. For crypto investors, this law introduces a period of adjustment but also reassurance. Licensed exchanges will need to identify all account holders through verified identity checks and track high-value transactions using government-approved software. This significantly reduces opportunities for fraud and anonymous transactions, changing how individuals manage digital wealth. Investors who previously relied on offshore exchanges may face difficulties transferring assets unless those platforms comply with UK regulations. On the positive side, these standards will improve market confidence, allowing greater institutional participation from banks and traditional financial entities. The Act also defines taxable events more clearly, meaning profits made from cryptocurrency trading, staking, or mining must now be declared through standard self-assessment processes. Keeping detailed transaction records becomes an essential habit for maintaining legal compliance. For businesses experimenting with blockchain technology, the licensing requirement paves the way for long-term growth through legitimate frameworks. Startups focusing on decentralized finance, tokenization, or digital payments can now operate within a structured legal environment, reducing uncertainty and attracting investors seeking regulated opportunities. Consumers gain stronger guarantees about fund safety, with all licensed entities required to hold adequate insurance reserves against losses. The Crypto Asset Regulation and Licensing Act signals the UK's transition from an experimental crypto landscape to a regulated digital economy, one where innovation and accountability coexist to secure the financial future of both entrepreneurs and everyday investors. Number 5. Property and Rental Restriction Bill. The Property and Rental Restriction Bill is one of the most impactful reforms in the UK's housing sector, designed to address the ongoing shortage of affordable homes while targeting high-yield property investors. This law introduces stricter regulations on the buy-to-let market, increasing taxes on landlords who own multiple residential properties. It sets a limit on the number of investment homes that can be owned under a single entity without incurring higher tax rates. The government aims to discourage wealth concentration in real estate and make housing more accessible to first-time buyers. Additionally, shorter notice periods for tenants, restrictions on arbitrary rent increases, and stronger tenant protection clauses have been incorporated. These adjustments intend to balance power dynamics between landlords and tenants, ensuring more stability in the rental sector. However, many property investors argue that these measures may shrink the profitability of rentals, potentially decreasing housing supply in urban hotspots. Real estate analysts believe this law could reshape property ownership trends over the next decade. Investors who previously benefited from rapid portfolio expansion are now reconsidering their strategies, with some shifting toward commercial or overseas properties. The bill also introduces mandatory registration for all rental landlords under a national database, where every property transaction and tenancy agreement must be recorded. Local councils can now monitor and enforce compliance more effectively, reducing the risk of illegal evictions and unregistered rentals. The new framework also encourages environmentally sustainable upgrades by offering minor incentives for landlords who retrofit their properties with energy-efficient technologies. By tightening oversight and linking compliance to tax adjustments, the government seeks to promote fairness and quality housing for residents across different socio-economic backgrounds. For ordinary citizens, this law presents both challenges and opportunities. Renters may benefit from improved living conditions and better protections, while aspiring homeowners could experience less competition from large-scale investors. Yet small landlords may face rising costs and added bureaucracy, which could translate into temporary rent adjustments. Financial advisors suggest property owners diversify portfolios through real estate investment trusts, IREITs, or cooperative housing projects, which offer lower risk and shared responsibility. Ultimately, the Property and Rental Restriction Bill seeks to recalibrate the housing market, reducing speculative ownership while fostering a more equitable path toward long-term, sustainable home ownership within the United Kingdom's evolving economic framework. Number 4. Online Payment Monitoring Framework. The Online Payment Monitoring Framework introduces new standards for how digital payment platforms operate within the UK's financial landscape. Under this law, services such as PayPal, Revolut, and other online wallets are now legally obligated to report large or suspicious transactions directly to the Financial Conduct Authority. The aim is to curb fraud, money laundering, and undeclared income associated with digital commerce. Every transaction that surpasses the preset threshold is tracked and logged within a national transaction registry. While this system intends to reinforce financial transparency, it also changes the dynamic between consumers, businesses, and platforms. Freelancers, small enterprise owners, and online retailers who rely on instant digital transfers now face tighter scrutiny. Each payment must include more detailed sender and receiver data, significantly reducing the possibility of anonymous exchanges or unverified financial interactions between accounts. For growing digital entrepreneurs, these changes create both obstacles and clarity. On one hand, there is an increased administrative burden, with platforms requiring verification through digital identification systems before approving large payments. On the other, this framework helps legitimate businesses distinguish themselves from fraudulent players operating across online markets. Revenue streams from international clients will require consistent documentation to prevent unnecessary delays. This will demand proper record keeping and tax alignment to remain compliant with evolving regulations. The government's motive is to ensure an accountable ecosystem where money movement is visible, traceable, and lawfully recorded. Privacy advocates have voiced concerns that constant monitoring could evolve into unjustified financial surveillance, emphasizing the importance of strong data protection protocols. Nonetheless, proponents argue it enhances digital financial security and deters platforms from being misused for illegal financial activities. The broader impact of this law lies in shaping a safer and more credible digital financial environment. Citizens who adapt early by maintaining transparent payment records, updating online profiles, and understanding reporting limits will find their routines minimally disrupted. For the average user, these measures will likely result in faster fraud detection, fewer scams, and higher trust in digital payments. Businesses will have to invest in compliant software capable of automatic reporting, while consumers gain the assurance of safer transactions. Although the online payment monitoring framework increases oversight, it ultimately aims to strengthen accountability and build a future where financial trust and digital transparency operate hand in hand across the United Kingdom. Number 3. Carbon-linked consumption tax. The carbon-linked consumption tax represents a fundamental shift in how everyday spending is connected to environmental responsibility. This law introduces a variable tax rate on goods and services based on their carbon footprint, ensuring consumers contribute proportionally to environmental preservation. High-emission products, such as air travel, imported luxury clothing, and certain types of fuel now carry additional charges reflective of their environmental impact. The government's objective is to encourage greener lifestyles and cut national emissions while generating revenue for renewable energy initiatives and carbon offset programs. However, this tax directly affects household budgets, making certain daily items costlier than before. It seeks to modify public behaviour gradually rather than imposing outright bans, pushing citizens and businesses to reconsider what and how they consume. Retailers will now display the carbon score of products, giving people transparent insight into their environmental effects before purchase. Financial experts predict that the carbon-linked consumption tax could transform consumer economics across the UK. By linking cost to ecological damage, it creates a measurable incentive to support sustainable production and local industries. Imported items produced through carbon-intensive methods may lose appeal as domestic eco-friendly alternatives grow. Manufacturers are under pressure to adopt cleaner supply chains to remain competitive. For consumers, the change offers both challenges and opportunities. Everyday expenses, like energy bills and transportation, might rise. Yet small adjustments, such as using public transport, recycling more, or supporting low-emission services, can reduce overall costs. The shift also encourages long-term savings, as energy-efficient living becomes financially rewarding. Moreover, companies investing in sustainable practices can benefit from tax relief incentives, stimulating innovation and fostering greener job creation across industries. This law symbolises the UK's commitment to climate leadership, aligning its economy with international climate targets. It acts not just as a financial penalty for heavy polluters, but also as a national guide for cleaner consumption. Families can expect gradual adaptation, with the government rolling out rebates and educational support to promote energy literacy. Over time, this measure may influence cultural attitudes toward consumption, turning environmental awareness into an everyday habit. While some criticize its immediate financial strain, others view it as a necessary evolution toward collective accountability. The carbon-linked consumption tax redefines economic success, blending financial responsibility with environmental integrity to create a sustainable model for future generations. Number 2. Wealth Disclosure and Transparency Law. The Wealth Disclosure and Transparency Law is one of the most controversial policies reshaping personal finance across the UK. It requires citizens with assets exceeding $250,000, including property, stocks, bonds, and foreign accounts, to declare their full financial holdings annually. The government's stated goal is to promote fairness in taxation, prevent hidden wealth accumulation, and reduce financial crimes such as offshore tax evasion. Every declaration must be submitted through the newly established National Financial Register, which centralises asset data. This system enables tax authorities to detect inconsistencies between reported income and declared possessions. While designed to strengthen the nation's fiscal integrity, this law has sparked debate among investors and middle-class professionals who feel it imposes unnecessary intrusion. The penalties for non-compliance can be severe, with hefty fines and even the possibility of asset freezes for repeated violations. Economists note that this law represents a shift toward greater transparency in global finance, aligning the UK with international regulations under the Financial Action Task Force. For individuals holding assets abroad, the rules demand accurate documentation of all foreign accounts, trusts, or property ownership records. Even cryptocurrency portfolios are now part of the declaration process, closing potential loopholes in digital wealth concealment. Some see this as a step toward a more equitable fiscal landscape, ensuring that all citizens contribute proportionally to national revenue. Others argue it undermines privacy, discouraging entrepreneurship and international investment by adding complex paperwork and tighter scrutiny. Many accountants urge citizens to digitize financial records and consult experts to ensure compliance while minimizing avoidable tax burdens. The law emphasizes accuracy, meaning any discrepancy between declared and actual holdings could trigger investigations. For everyday citizens, the true impact lies in lifestyle adjustments and financial awareness. Owning multiple properties or having family income streams abroad now demands careful reporting, shifting how people manage long-term wealth strategies. The law encourages transparency not only from the wealthy, but from anyone seeking to build generational assets. Although the administrative requirements may seem tedious, they push for an honest, traceable economy where accountability defines financial success. As enforcement expands, citizens will need to adapt to this new era of financial visibility, where clarity, documentation, and regulation shape the foundation of secure economic participation across the United Kingdom. Number 1. Digital Pound Regulation Act. The Digital Pound Regulation Act has officially introduced a central bank digital currency, CBDC, into the UK's monetary system. This law aims to modernise transactions, streamline digital payments, and enhance economic monitoring. Every digital pound is backed directly by the Bank of England, meaning its value is fully guaranteed. However, this shift also introduces a significant change in how personal financial data is tracked and stored. All digital pound transactions can now be logged under a centralised ledger, allowing financial authorities to monitor movement and prevent illegal uses such as money laundering or tax evasion. While this brings transparency and accountability, It also raises questions about individual financial privacy and the concentration of fiscal power under government oversight. Many financial analysts see this act as the foundation for a cashless economy, shaping how people handle money daily. Businesses and consumers are encouraged to adopt digital wallets linked directly with approved banking systems. Everyday purchases, groceries, transportation, and bills can be executed instantly through official digital pound apps, removing the need for intermediaries. Yet this level of integration also means reduced anonymity and more traceable spending patterns. Critics argue that constant data monitoring could lead to potential misuse or overreach if sufficient safeguards are not enforced. Therefore, maintaining a balance between innovation and protection becomes crucial within this evolving digital space. Citizens must familiarize themselves with new transaction rules and ensure their devices maintain appropriate security features to safeguard against unauthorized access. The Act also intends to empower the government to respond more efficiently to financial crises or policy adjustments. With stronger control over money flow, interest rate changes and stimulus distributions can occur almost instantly through digital transfers. Economic policies that once took weeks could now be executed in minutes. For ordinary people, the benefits could include faster payments, fewer bank fees, and greater transactional clarity. Yet such convenience comes with the cost of oversight and dependency on centralized technology. As digital finance continues to reshape the national economy, those prepared to understand and adapt to these shifts will hold the greatest advantage in navigating the UK's emerging financial era. These sweeping changes to the UK's financial laws reveal a system evolving at breakneck speed, demanding greater attention and adaptability from every citizen. Navigating new rules on digital currency, property, savings, and retirement plans isn't just about compliance. It's about actively safeguarding your future and seizing emerging opportunities. Whether you're a small business owner, an investor, or someone planning for retirement, staying informed is now more essential than ever. Understanding each law's impact on your daily transactions and long-term goals can make the difference between merely keeping pace and thriving in a new financial era. Proactive steps, like reviewing saving strategies, embracing digital tools, and consulting financial experts will empower you to not only withstand these shifts, but use them to your advantage. If you found this video helpful, don't forget to hit the like button and subscribe for more vital updates that could impact your financial well-being. Share your thoughts or experiences in the comments. Your perspective matters. If you want deeper insights or practical tips, check out our related videos. Stay informed, stay prepared, and let's shape a secure future together.